All right, welcome everybody to the May edition of Dashboard Diagnostics. I think we've got a fairly interesting, fairly compelling, and perhaps even provocative program tonight. Perhaps induce a little bit of head scratching. The club that we're featuring tonight is one that did not choose the Witness Protection Program. They're actually going to admit who they are, and we thank them for that. But it's a very well-established club that I've actually spent time with in one capacity or another since at least the mid-1990s, and I've come to know them pretty well, and they have an interesting story to tell here tonight. Just starting off with the cover images there, the little girl on the left here, I thought that was kind of cute, the Nest Tea plunge there, and it's just to me it's a kind of reminder that as investors you're never really an expert investor. I think Dan Hess says it best when he says he's still learning, and I think that's true for all of us. And I think the last time I checked, Dan has been investing, doing analysis and stock studies for about 40 years. So I mean, when he admits that he still is learning stuff every day, I think that's pretty exciting. Probably an even more vivid example of that I experienced, and I've written about this in visiting the Beardstown ladies in Beardstown, Illinois, back in October, where we actually had a fairly animated discussion about the fact that the Beardstown ladies, one, they're actually bringing in a new group, a new generation of younger ladies, but second, they're actually exploring a conservative option strategy known as covered calls. And part of the reason for doing it is just to keep them fresh, keep them thinking about, the world of investing and exploring things which might have, an incremental advantage. And that's exactly why we look at them also. The little girl on the left there is just to remind us to maintain that youthful exuberance and remember that there are always opportunities to learn out there. Now, we're going to be talking in a minute about the plungers, but I also kind of want to throw them into what I think of as a compendium of 2 or 3 clubs that have multi-decade experience that we've been working with lately. And in fact, one of these clubs, not necessarily the plungers, but actually came to us and said that they were within inches of disbanding and going away literally after 20 or 30 or in this case, nearly 40 years of operation. And after spending some time talking about some of the concepts and philosophies that we're going to be talking about tonight, in fact, you're going to see that the plungers have adopted some of those concepts and they're exploring them very carefully. This other club has remained in business and it has literally found a way to bring them together. And I think I witnessed that with the plungers. I actually met with the plungers last week, and not knowing exactly what I was going to experience, we'll wait till you see what they showed me and some of the stuff that we talked about. And then last but not least, that image there on the right is just a recognition of the reality that there are bumps and roller coasters and ups and downs in the stock market. And George Nicholson was pretty firm on his belief that more intermediate or advanced investors, there are certain things that you might want to take advantage of, and those are some of the topics we're going to be exploring tonight. Topics like capital preservation and working on some things which preserve capital during those market downdrafts in order to empower the club to do better, coming out of the things like we just experienced with the Great Recession. So those are some of the themes that we're going to actually tackle tonight. And let's start by just giving a little bit of background on the club. Club is the Plungers out of Birmingham, Michigan. Again, I think they're at about 18. They're just short of 20 ladies. They're a wonderful group. Again, going on at least 25 years of experience as far as I could recall. And I may be off on that number, but it's at least that much. And again, not necessarily them, but again, part of these clubs that we've been working with, thinking about giving up, getting frustrated. Not necessarily true for the plungers, but I think if we actually dug in and looked at their performance, and that's why the cup is there, I can recall that they were chosen as one of the leading investment clubs by the Better Investing Club Performance Survey several years, from the mid-1990s through the middle of the next decade. And I think their performance really has probably suffered a little bit in the last 5 years, and that's why they are looking for suggestions and things to think about, perhaps bringing back some incremental performance. But again, make no mistake, this is a club that has been around for a number of decades, and they've done quite well over the long term. And then just the simple thought that are there some things that we should really know about long-term investors, long-term investing, and coming at it from the standpoint of admitting that we're all still beginners, but is there a point in time where we really should perhaps embrace some other concepts or philosophies in the search for better performance. Okay, again, our quick disclaimer before we get started. You guys all know this drill. I see several names that we recognize and have been here many times. There may be a few of you that are new. This is intended to be an educational demonstration for educational purposes only, and that line at the top says it all, or the second line down. No investment recommendation is intended. We will be talking about real companies, real time, giving analysis and commentary. And again, just keep in mind that you already know, if you're anywhere near this community, that we expect that you must do your own homework, make your own decisions. Okay, I put this next slide in here to just basically show the evidence that this club, this is actually from the 2005 results, was among the leaders in the state of Michigan for that year, and they were actually a national finalist. And I know that they had been, again, national finalists several times over the preceding 10 years, and a real solid track record. And then I also noticed that we've got people here like Dick Vogel, and he was a part of this Des Moines club out of Des Moines, Iowa, and there are other clubs that actually came to know and working together with these clubs over the years. In fact, manifest investing, many of the things that we pursue and try to build at Manifest Investing is based on working with so many of these clubs and watching what they do. I see the club from Monmouth, Illinois, the ladies there, the Today's Women Investment Club. They were a national finalist. The Pittsburgh Chapter Model Club down there at the bottom. The Good Stewards Investment Club, they were actually won the national contest, I believe, 2 years in a row in 2003 and 2004. So again, much of what we do is based on the types of things that we've learned from working with clubs like the Plungers, and in fact it was the genesis of this program when Lori suggested it a couple years ago. Here's a quick reminder just for, first of all, the reason that we're here in the first place is the gentleman there on the left. George Nicholson is regarded as the grandfather of the modern investment club movement. And if I could encapsulate some of the stuff that we'll be talking about here tonight, it really does come down to this perception, or I think it's a reality, that much of our investment club training during those first 3, 4, 5, 6 years really is an extremely solid basis in the fundamentals. It's an awesome analysis of studying stocks. Nicholson was the creator, the originator of what is known as the stock selection guide. But he also, in some of his teachings, also encouraged clubs with a little bit more experience that it's okay to kick off the training wheels and delve into some other stuff, and that's some of the things that we will be talking about here tonight. A lot of the stuff that we're going to be kicking around tonight comes from, again, lessons of history. The book there on the left was the 1984 Individual Investors Manual for, it was actually the manual that went out to not just individuals, but individuals and I believe clubs up into the early 1990s. And a couple of the concepts we'll be talking about here tonight, he spent just a few pages on later on in the book, pages 94 and 95 and a couple others later on, and just this notion of general market securities and this concept of overall balanced investing and an opportunity to preserve capital during some of those bear markets. Again, the Great Recession taught us many things. That roller coaster is a reality in the stock market. And if stocks are going down 40, 50, 60%, sometimes it makes all the sense in the world to take your time, perhaps leave things in cash a little bit longer, and just protect yourself during some of those swoons in the market. Let's talk about two areas that have been perhaps a little bit frustrating for clubs here over the last 10 years, and even more markedly so here over the last 5 years or so. This is actually a look at the 10 sectors recognized by Standard & Poor's. From left to right, they're ranked by their 10-year annualized returns by sector. So you can see that the top performing fund over the last 10 years has been energy. So again, energy has been a place that's been fairly kind to investors, all the way to the right-hand side of this, where the communication stocks, your Cisco Systems, other companies in those areas. Some of us had painful experiences with ADC Telecommunications, And then finally, the financial sector stocks have been quite punishing here over the, especially the last 3 to 4 years. So those two sectors have actually, way underperformed the other sectors in the group, with everything else in between. You can see that staples actually still did, pretty much okay. It's always a good idea to have some staples in your portfolio. But some of our favorite sectors are these over here: the discretionary, the healthcare, the technology, and certainly both of these, in addition to the staples. And traditionally, what are the most likely sectors to be held by many of the investors within our community? Again, this is a sweeping generalization, but if you start looking at the statistics, you'll find that for the most part, many investment clubs will not even have any energy or materials or industrial stocks within the portfolio. So these three that have performed pretty well on the right, with the exception of staples, are actually kind of fugitive from many of our portfolios. Just something to be more aware of. And here's a look at it. These three sectors are the least commonly found in most club and community member portfolios. And one of the reasons that we just want to make this point is these sectors are going to be home to, in general, more of what we would call these general market securities, is what Nicholson called them. We might call them non-core. Again, not necessarily up straight and parallel, but general market securities, and they're typified by things like cyclicals, low growth. That could be stocks that have a 3% growth rate or less. Utilities would certainly fall into that group. Emerging stocks which don't have 5 years or 10 years or 5 years of history. And then, of course, the turnarounds, your Rite Aids, which hasn't worked out too well yet, but the turnaround stories. And there are, in some cases, pretty wonderful opportunities in those areas. And this is an area that the Plungers have declared that they really want to explore and understand, go there when they can. And let's just come back to the first type that's listed there, that first category, cyclicals. There's a great myth within our community that cyclicals should never be invested in. And that is never what Mr. Nicholson intended. He was quite clear on this. He said, you shouldn't invest in cyclicals until you know what you're doing. And if you don't know what you're doing, it's a place of, frankly, clear and present danger for most investors. But once you start to understand some of the characteristics and attributes, you can avoid some of the minefields. And he knew that. And again, his counsel was, invest in them, but please don't invest in them until you have studied them carefully and you know what you're getting yourself into. So again, part of the frustration that we've seen with many clubs, and again, this is not specific to the Plungers, but I believe this is some of the stuff that they're looking at wanting to understand deeper and better. Again, the top performing sectors are on the left, and many of our favorite sectors are on the right, and that has not helped frustration and anxiety levels in many clubs within the community and individual investor portfolios either here over the last several years. So again, if you're avoiding those bumpier sectors, chances are your returns are down over the last several years. Another key area that we have talked about with many clubs, and in fact the clubs around here are actually showing great progress in this area, is this notion. In fact, Ken Kabul and I have a fun presentation we do where we talk about the sacred tablets and how we've never been able to find the sacred tablets. So we turned the NAIC building upside down and didn't find the sacred tablets. And just these rules that have been applied, and the distinction in many of the rules that we all know so well is that they really were intended for beginners to protect them from certain dangers in the market. The limits on PEs, the limits on growth, thou shalt not invest in cyclicals. Again, guidance intended to protect beginners. And we actually slated out about 10 of these that we could put on our own little tablets, and Ken and I were kind of amused that only one of the 10 survived the test of that beginner to advanced transition, and it's this one. Thou shalt diversify by size, and this is an extremely important one. We can't repeat this one, too often, especially in these dashboard diagnostic sessions. What you see here is a comparison, and again, this is over the last 10 years of the S&P 500, shown right here, The S&P 500 is made up of a bunch of blue chip large company stocks, and you can see that that has been, it's had some ups and downs, but has been relatively flat over the last 10 years versus the Russell 2000. And the Russell 2000 is an index of 2,000, relatively smaller companies. And you can see that, again, it's not without its ups and downs. It's also a roller coaster, but over the 10-year period, the performance of the smaller companies has been superior over the last 10 years. So if you were in one of the clubs out there that was really, carrying too many large companies, you could be basically setting yourself up for weaker performance. Here are the words right out of that 1984 investor manual where Nicholson counseled, you got to choose from small, medium, and large, 25% in large, 25% in small, and the balance, the 50% balance in the rest. In other words, medium-sized companies. And you want to build your portfolios out to have sufficient growth across the board in the portfolio, that 10 to 12% on average across the board that you see at the bottom. So again, if you're in a club or in an individual portfolio where you've been reluctant to invest outside of the blue chips, you could be suffering from a condition known as core stock addiction, and you could have actually experienced the lost decade that we hear so much about on the news. I mean, here you can't make it any plainer than this. The S&P 500 over the last 10 years has gone basically nowhere. The Russell 2000 has actually done, fairly well, bolstered many portfolios, and you can see the rather dramatic effect of that recession, which became known as the Great Recession. It dinged both the blue chips and the Russell 2000. You could even call them red chips. But the other thing that we've always known to be true, and we've counseled very, very carefully at Manifest, is that, again, Peter Lynch's admonition that you should really be shopping for smaller company stocks as recessions appear to be ending. And in this case, it was dynamically true. If you had some smaller companies, perhaps even some of those non-core companies in your portfolio coming out of the recession, they did quite well. And then again, just as you study some of the stuff, the attributes of cyclical companies, the cycles of the market and the economy, notice what happens to companies, through that gray period. Some are less impacted than others. You have to protect and cover versus other companies. Some companies dropped 80 to 90%, while others dropped 10. And again, much of it has to do with how they respond, how they respond, or how sensitive they are to recessionary conditions.